how do you see cannabis? Like, do you see cannabis as more of a luxury item? Do you think there's a place for that in this space? Or do you see it more as like a CPG, like consumer staple, something analogous to like what you would see in like the beer and wine industry?
Hey everyone, welcome to our latest TDR Cannabis exclusive. And yes, you're going to like this podcast here today. We've listened to you and we finally got a chance to sit down with the CEO of AYR Wellness, trades on the CSC under the ticker symbol AYR.A. Let's welcome in David Goubert. Our audience is going to be extremely happy. We've been getting emails every week for the past 8 weeks. When are you having David on? Here you are. You're a busy guy. How are things?
Man, I'm so happy to hear that. Well, thanks for having me. And yeah, excited to be here with you guys.
Yeah, Anthony Varrell, this has been a story that you've talked about for probably a good 90 days. And man, it's been a hot topic for conversation with what you've gone through, right?
Yeah. It's been a long time coming. I'm glad to have David on the program, and glad to finally get dig into the story.
Yeah. So let's talk. I don't want to say it's old news, but let's maybe dive a little bit into your financial results from last month, including a period of significant year-over-year adjusted EBITDA growth and cash flow generation. You reported a 21% year-over-year increase in retail transactions on a same-store basis during the third quarter, which is encouraging. So all in all, as we, close the door on 2023 and open the door to 2024, we were at MJ Biz last week in Vegas. There's a lot of positive sentiment pertaining to the actual, industry itself, but your company specifically, a lot of stuff that you've announced over the last, 30 to 60 days. How do you feel going into a brand new year?
No, I'm excited about getting into the brand new year, and I'm excited about where the industry is in general. I'm sure we're going to talk back about the year 23 for AYR and the priorities and what we achieved. But overall, very excited about where we are and what's to come in 24. And frankly, even more excited about 2025 and 2026 for the industry and for AYR. And I'll talk about that, considering that I'd say 2023, it's been a year for us of getting back to basics and getting leaner, meaner, more efficient, and preparing for the future. And there's a lot of tailwinds that we think are going to come. And I think 2024 is still going to be a year of transition in a way, meaning super focused on cash preservation while at the same time preparing for the growth that's to come.
Yep. Definitely a huge step in the right direction. Go ahead, Anthony.
Definitely. I was going to say, David, a lot of the story with AYR, I mean, really the turnaround happened when you were installed as CEO of the business. I know your background, Neiman Marcus, LVMH, high luxury. How do you see cannabis? Like, do you see cannabis as more of a luxury item? Do you think there's a place for that in this space? Or do you see it more as like a CPG, like consumer staple, something analogous to like what you would see in like the beer and wine industry?
Yeah. So to your point, I come from a very different industries and joined a year ago with no knowledge of the industry and no knowledge of cannabis. So the first step for me,
really,
no. The first step for me, and I could tell you afterwards why cannabis and why joining the industry. But I'd say the first step for me has been for 3 months from November 22 to January 23 to try to make sense of the business, understand who are we, right? Yeah. Who are we and what's the business model? And man, it's a really complex industry. We're at the same time farmers, growers.
Yeah.
We process products. But we're at the same time a retailer where we sell our own products, but we sell products from others, whether they're small growers or other MSOs. We're also a wholesale business. At the same time, we have our own brands and we build our own brands. So to your point, more as a CPG company. And we need to make sure that we develop products that correspond to those brands. So that's a pretty complex business. And I took a step back and I was like, okay, what can we compare that to? And I could not find another industry that you could truly compare that complexity with. And so in my head, I was like, okay, we're at the same time a retailer. Like today we have 89 stores, right? Yep. Across 7 states, soon to be 8. So we're a retailer. But at the same time, again, as we were saying, we have our own brands, we produce and so on. So we're a CPG company. And the way I tried to make sense of that was to say, we're at the same time, or we need to be at the same time, the retailer of choice of our customers. Mm-hmm. Yeah. We also need to be a house of brands where the brands mean something and have equity. And the way for us to make sense of the business was to say, okay, as a retailer, if I compare to my old world, I'd say we're at the same time a Sephora and a L'Oreal.
Yeah.
Sephora is a retailer. Okay, they have their own brands a bit, but they're a retailer. As a retailer, doesn't matter what business, doesn't matter where you are. What matters is customer loyalty and building customer loyalty.
Hmm.
So as that, we said, okay, we're a retailer as AYR Cannabis Dispensary. Let's make sure that the focus of the team, our focus overall, is building customer loyalty.
Was
Like,
that missing before, you think?
I think it wasn't a focus, and it's not specifically AYR. I don't think it was a focus in the industry per
Interesting.
se. Like if you go to a dispensary or store and you ask the store manager, "Hey, this month, how many of your customers are customers that have been shopping for a while with you, and how many new customers do you have, and what's
Yeah.
the retention of the existing customers, and what's their frequency, and so on?" That's not a language that's very um, usual, at least for what I experience at AYR. So
Now, do you think that that gets more that gets more integral into the business as a market goes from adult use, that a market goes from medical to adult use, and you see that maturation of the market, or you think that needs to be implemented at the ground level to start with a medical market?
now I think it's from the medical market. Like as a footprint today, out of 89 stores, we have only, which by the way, it's pretty awesome when you look at the future, but we have only 15 stores that are adult. So we
Yeah,
have out of 89 stores, I mean, the vast majority are in medical market. And I was in Pennsylvania actually until yesterday. That's the questions I'm asking to the stores is how many of your patients are repeat versus the patients that are new, and how do we do to maintain the continue to have that loyalty of the repeat and create that loyalty with the new customers. So back to the model, I think that the only focus as a retailer is making sure that you build that. There's many ways to do that we need to work on, but
Yeah.
that's it. And then as a house of brands, what you need to focus on is having brands that have equity and not just, frankly, packaging with a logo on it. That means nothing. So the work has been very much creating that. Now, I'm not answering directly your question, which is what's the link with luxury?
yeah,
I think that luxury, same thing. Luxury is two things. Luxury can be retailers. I worked at Neiman Marcus. It's a retailer. There's no Neiman Marcus brand. Focus is customer loyalty. Um, I worked at Louis Vuitton. It's a brand.
Yep.
The only thing that matters at Louis Vuitton is creating a story around the brand and getting people to be excited about the brand. We got
Bingo.
to be both. So that's where that's where I'd say the fact that it's in some ways similar, I would say, come from to both. Now, the interesting thing is that luxury, you see your customers 3 times a year. They spend between $500 and $1,000 every time they come. So the
yeah,
value of a customer is $2,000 to $3,000 a year. The value of a cannabis customer is the same.
Okay.
yeah,
Be the same because they shop 25, 50 times actually a year. Depending on the states, you're going to be at between $50 and $120 transaction. So if you multiply that, you actually have customers that have the exact same value in cannabis than they have in luxury. Now,
yeah,
if you ask me, I'd rather have someone that I can talk to 25 times a year
Yeah.
than 3 times a year.
Yeah.
absolutely.
So those are the similarities, right? That we see and that we're working on. I would say in terms on the retail side, which is about building customer loyalty, and on the brand side, and we're not there yet at all. But on the brand side, how do we create brands that really have equity and that we can invest on?
Was that what was that something that you identified in Kiva when you decided to bring them to Florida? That they were a brand that had equity, that resonated, and that is noticeable in the market.
So Kiva is a very interesting topic for us because I think Kiva serves both,
But yeah,
meaning
they did. They do.
especially in Florida,
Yeah.
because Kiva is a brand that has equity, and there aren't that many in cannabis that
Yeah.
exist. But Kiva has equity, so for us that helps us because it's a brand that we partner with that has real equity in the cannabis industry. The second thing is that what's awesome about Florida is that the only place where you can get the products is actually in your own stores because there's no
Yeah.
wholesale in
Yeah.
Florida. So we also saw Kiva as a way to attract customers and retain customers into our stores. So it serves as the brand equity, but it serves also on the customer loyalty and building that customer loyalty.
Yeah, and speaking of Florida, I know you've got about 750,000 square feet of cultivation in the state. I think it's the 360 campus
Yeah,
and it's up by Gainesville.
yeah, it's
If
Gainesville.
it,
Yeah,
a lot of the talk around your story is Florida. A lot of the talk around Florida is adult use conversion. Do you foresee that facility being able to service your assets in the state of Florida, or do you think you're going to need some sort of incremental capex spend and incremental
yeah,
cultivation to
yeah.
service once adult use flips?
So I think that's the one state out of where we are today. That's the one state that we will need more, I'd say, cultivation capacity in Florida once
Yeah.
it's before it turns adult. Like we need to be ready for it.
Yeah,
And frankly, we're going to need that to be an indoor facility,
yeah,
considering that 360 is an improved greenhouse, I would say. But we're going to need that in Florida. It's the only state where today, I mean, there's been a lot of investments made in air, which explain also where the depth is of the company, right?
yeah.
But if you look at our footprint, we have the capacity in pretty much every state we're in from a cultivation standpoint. I'd say the one exception today is Florida. So
Yeah.
we have way enough for the business where it is today.
Yeah.
Yeah.
I think that if we take the assumptions, the usual assumption that when you turn from medical to adult, you
Yeah.
double or triple,
Yeah,
that's going to be an awesome problem to have.
very much
Um,
so.
and
Well
Very,
said. Well
yeah,
said. Arguably the largest cannabis market in the world when this flips to adult use, right?
yeah, well, hey, if you look at it, it's a $2 billion business, I think, with a bit less than a million medical card holders out
Yeah.
of
yeah,
3 million people living in the state. And then what is it, 40, 50 million tourists a year
Yeah.
between Miami, Orlando, Tampa. I mean, yeah, that's going to be awesome.
100%. So you spent what, 20 years at Neiman Marcus? Am I understanding that correctly?
Yeah, I spent 4 years at Neiman Marcus, but I spent about 20 years at LVMH. So Louis Vuitton
Gotcha.
went before that. So and
And
and 15 of those at Louis Vuitton. Yeah.
10 short months ago decided to do cannonball right in the middle of the cannabis industry. What would you say in a couple of words is what you've learned the most about this space? Mm.
I'm going to tell you why I joined, and then that confirmed over the past year that I've been here.
Okay.
I mean, there's a different reasons I joined, but one of them is that I really wanted to be in an industry where I felt there was a real purpose, that we're serving people for a reason.
Interesting. Okay.
And that was, I mean, I was at the time of my career in luxury, which I was lucky enough to had great jobs,
Yeah.
and I was running the Neiman Marcus brand, meaning company, before joining. But at some point, I felt that I needed to be in an industry that I felt had a greater purpose, and that's why I joined. Plus the fact that I'm an engineer at the beginning. My background is manufacturing, supply chain. That I went into retail. I did
okay,
e-commerce, marketing. So, and Louis Vuitton is a vertically integrated company as well, like that produce the bags and sell the bags and so on. So I felt the experience that I had over the years could fit well with a vertically integrated business
Yeah.
like this. But the main reason was that I'd say passion that the people have for the plant and how it's serving a purpose. So even before joining, the question I would have to anyone working in the industry, not only at AYR, but in the industry is, why are you working in cannabis?
yeah,
And every single time, I think I have only 2, 3 cases where it was not the case. Every single time was because it changed the life of someone around me. And so when you ask me what is the most striking, maybe after a year,
Yeah.
it's that proved to be true.
Interesting.
yeah,
And it continues. I still do the same this week, visiting, meeting more of our teams. It's like, why do you work in cannabis? There's always a story, and every time you get goosebumps about that story. So I hope that with the changes, even from a federal standpoint, like
yeah.
we're going to get more and more people that will understand that and will be able
Yeah.
to do more research. But that's the why.
It's always fascinating the people that we meet in this industry because yes, the plant's been around a long time, but it's a brand new industry. But one thing I would say, Anthony, that we see consistently, especially with a lot of executives in this space, everybody's just so passionate about where the
Yeah.
future of this industry is going, right?
Yeah.
Yeah, I mean, it's an industry. It's an industry of passion and purpose. I mean, David's completely right. I mean, you can look
100%.
through people very quickly that are here for profit, and the businesses that are here for profit are short lived. They don't have too
Yeah.
much staying power. in the
Mhm.
industry. But I mean, David, I mean, one thing that I wanted to tackle that we kicked off November with was the announcement for your debt restructuring.
Yeah,
I was a fan. I was a fan of the deal. Finally getting it tackled, kicking it out until December 2026. It can
yeah.
convert at the end. What would you say to the investment community that saw that as a net negative for the business?
Yeah, well, hey, if I look back at a year ago, right,
Yeah.
we were in a situation where we had to start paying significant debt by May 2024, and we had
Hmm.
everything by December 2024. So
Yeah.
basically, we had kind of a sword above our heads on what needed to happen. It was imperative for us to manage to push the maturity of the debt, and it's an expensive deal. Like I'm not going to lie to investors. I mean, when you have to dilute by 25%, if I consider that the warrants will be exercised, it's not a cheap deal.
Yeah.
But at the same time, it's a deal that give us a runway
Yeah.
until a bit mid 26, but mainly the end of 26, right?
Yeah.
And when you look at that, and when you look at all the tailwinds that this industry has, and
Yeah.
how air is actually, I would say, exponentially exposed to those catalysts and to those tailwinds. Um, yeah, it's an expensive deal, and I can understand that some people are saying, "Hey, 25% of dilution is quite significant," but the company will look very different 2 years from now than what it was a year ago.
100%.
Time what we did last year, the focus of 23 has been about making this company way more efficient. And
Hmm.
we moved from 18% EBITDA a year ago to consistently 25% EBITDA now. So those two things, debt restructuring plus becoming a leaner, meaner, more efficient company, are really the two key focus that we had in 23, and obviously building the foundation for growth. But when you look at our footprint, I mean, we talked a bit about it, but
Yeah.
we're in 7 states. Out of the 7 states, we're in Florida, we're in Ohio, we're in Pennsylvania. Uh,
Key
Again,
markets, great markets.
80% of our stores are medical today.
Yeah.
So
So
keying in on those tailwinds, are there provisions in that agreement to where you can leverage the free cash flow of the business to eat into that debt, so it's not so heavy on the conversion, um, if and when we reach December 2026?
yeah, so I mean, we're getting we're getting some additional cash coming in at the closing of the deal. So there's going
Yep.
to be 40 million that comes in at the closing of the deal.
Yep.
There's also the warrants that should exercise. That is, that if everything is exercised, would bring another about 50 million.
Okay.
So and that, you could say, some of it could be used as develop further the business, but a big part
Yeah.
of that will be used for the debt.
Okay.
And then yeah, we have the ability between now and 26 to actually figure out better deals when Schedule 3 will be passed and we don't have 280 anymore, and when these other tailwinds comes in. So
Yeah.
companies should look very different 2 years from now than it is
Yeah.
today.
So it's safe to say that it could be 25 to 30% down the road, but there's a chance that it's not going to be. So I mean, that's not in concrete. And now you have the 3 years of
Yeah,
flexibility to grow the business, financially improve it, and
Yeah.
then deal with that down the road.
yeah.
Which is why I was a fan of the deal, to
Mhm.
begin with. Talking about those adult use markets, I mean, I know that you guys have a presence in Ohio.
Yeah,
I know that you announced 2 dispensaries. I think it was about a couple weeks back. The third is now coming online. Do you plan to go up to the cap,
yeah.
in Ohio, and take full advantage of that
Yeah.
market?
So we're still looking at what's going to happen, meaning the conversations that are happening right now. So first, we're super excited about the vote. That's clear.
Yeah.
Now we're looking at what's going to happen in the actually these days today on exactly what's going to be the rules. What we hear so far is you can go up to 8, right?
Yeah.
Yeah.
Dispensaries. And basically that's what we intend to do. And when I look at investments in 2024,
Yep.
I'd say
Yeah.
number one priority is getting to 8 in Ohio. That's going to be number one priority for us in the investments in 24. By the way, 24 is still a year of cash preservation and
Yeah.
making sure that we stay really tight from a cash standpoint, which means that we're not going to spend this year. We'll have we'll finish the year at 30 million of capex, as we said.
Okay.
Next year will be probably slightly lower than that.
Okay.
And a majority of that, not a majority, but a good part of that, and number one priority, will be on the expansion of Ohio retail. We
Okay.
have, I think, 58,000 square feet of canopy
Yeah.
in Ohio. So we're in a good place from a cultivation standpoint. So we'll ramp up the rooms, but the capex is already spent, I would say, from a cultivation standpoint. So for us, the priority will be on building up the retail.
It's a $4 billion market, definitely a good size. If you
Yeah.
had to really pinpoint, when you look at AYR Wellness as a company 12 months ago to where you are today, what stands out to you the most?
Well, we talked about it. It's the debt restructuring,
Yep.
Yeah.
and it's how I think way more efficient we are today, and proven by the EBITDA that we can deliver, and cash flow that operating cash flow that we deliver now. So those are the key things, and obviously getting ready for those three markets, meaning Florida, Ohio, and Pennsylvania.
And I
Huge
mean,
market.
we haven't even mentioned New Jersey.
Yeah.
I mean, New Jersey is another market. So, I mean, with the markets that you guys are in, I mean, I've classified you guys as one of the businesses that's in probably the strongest markets that you'd want to be in right now from a growth perspective.
Yeah.
Is the strategy, let's say, from now until 2026 to go deeper into those markets, not broaden out into, let's say, like a Michigan or
Yeah.
or another nascent market that's emerging, just go deep and
Yeah.
own those markets that you're in?
Um, that's the priority. Totally agree with you. The priority is getting deeper and owning the markets we're in.
Okay.
And I'd say the main reason for that goes back to the business model. If
Yeah.
you want to build customer loyalty, and if you want your brands to resonate with the customers, you need to be deep and have a real market share in a market. If
Yeah.
we're at 1%, 2% market share, that means nothing, and we can't build customer loyalty, and we cannot build brands equity. So that means that number one priority is getting deeper in the states that we're in, whether we're talking about the one we've talked about, or, I mean, you talked about New Jersey, Massachusetts. It's more of a wholesale play than a retail play, but there's a
Yeah.
big play on wholesale. Frankly, we love Nevada. I mean, we're one of the ones that love Nevada. We're number one in Nevada. We have the highest market share there, which plays into our business model. And for us, that's a great state to be in.
A lot of people moving to Nevada too, right?
Yeah. And
And
the
that's
interesting
the
thing for
taxes.
us, interesting thing in Nevada is that it's actually a lot of local business. So yes, we have a
Yeah.
bit of tourism, but it's a super strong local business, very much so.
You've worked with like some of the most well-known premium brands in the world, and branding is always at the forefront of this industry. What does this branding landscape look like in this space over the next 5 years? Because like there's a lot of restrictions right now that eventually open up, but how do you see this playing out?
Yeah, the way we're looking at it, I think, is really having two different approaches. There's one which is the Kiva that we talked about, for example,
Yeah.
or other like that, which is not us, but brands that are they're not in only one category or one form factor, but they have a real legitimacy in a couple of form factors or a couple of things, and they're very specialized. And then they can play into a good, better, best wherever they position themselves, but really they become a real name for themselves in that. And there's a few others, whether it's on flower, whether it's on vapes, whether it's again on edibles and so on. But that's one part of the play. The other part of the play is, I think, having a few brands that are capable of really talking to the customer across the customer journey. And when I ask around me about people that, like, I see very few people that actually uh, consume cannabis only one way. Like,
Correct.
you can be, I mean, yeah, you're going to be smoking flower, or having flower at some point, and then if you're out with friends, you may have pre-rolls, and then hey, you may be into gummies for whatever, even for
Yeah.
sleep or something, and yeah, you can dab and so on, and it's going to depend on the moment in your journey. And I think that building brands that actually correspond to a customer, but can really cross over those form factors,
Yeah.
and not perceived as an MSO, perceived as a brand,
Yeah.
for us is the way to go. So we're in the process right now of changing completely the way we approach brands. When I joined, we had 12 brands, and pretty much anytime we had a form factor was a brand, right?
Hmm.
Okay.
We're changing that completely. We're moving from 12 brands to 3 brands only.
Okay.
Good, better, best, but making sure that they play across pretty much every form factor.
Hmm.
So I think it's going to be that.
So 12 brands down to 3. So
Yeah.
focus on what you know and do it really well, correct?
No, and it's also, even though you don't have much possibilities yet of investing from a marketing standpoint,
Yeah.
like in a different industry, you invest 5 to 10% of your revenue is invested into marketing.
Yeah.
Here we're low single digit in
Yeah.
marketing.
Yeah.
But when that low single digit is spread around 12 brands, that means you have
Yeah.
no investment, right? Make that 3 brands. First, the customer has more chance to be in front of that brand because they're going to be across those fun factors. And two, that gives us more power on making the brand known because if we use the same investment, now it's 4 times more
Yeah.
for each of the 3 brands.
Yeah.
So that's, and I'd say the work is done internally on doing that. We didn't want to go too fast because we had packaging and stuff, and we're not in a position financially where we can just throw packaging and start, right? So
Yeah.
we're doing that smartly. But by the first half of 24, everything will have moved to those 3 brands.
Yeah.
Now, are those 3 brands congruent between all of your markets, or is there some fragmentation between, let's say, Florida, Nevada, New Jersey, or the strategy is going to be to go congruent throughout?
So the strategy is to go across.
Okay.
And the reason for that is that products don't cross state lines, people do.
Yeah.
And we really want them to identify the brands wherever they go. And same for the retail name of AYR Cannabis Dispensary. So the principle is we want that to be as much as possible the same everywhere.
Okay.
Now, it depends on the regulation of each state, and especially in medical states, you got some names that are not necessarily approved yet in some
Yeah.
states. So we adjust state to state, but from a principle standpoint, we want to have those brand national.
Okay.
Products don't cross state lines, people do. I love that term. I have not heard that one yet, but that is a brilliant way of looking at it, right?
That is very
So
true.
if you put everything together, like one of the first thing we did, not my decision alone, but from a thing was disinvesting Arizona, right?
Yeah.
There's a lot of reason for that. The first one, we were below 2% market share and could not really grow that market share, so it doesn't play into the business model.
Yeah.
Two, when you look at where we are, we're in the southeast, we're in the northeast, we're a bit in Midwest, we're in Nevada, but everybody travels to Nevada, so it speaks to the same customers.
Yeah.
Arizona was a totally different market that did not cross with the others
Yeah.
we have. So, and I guess back to your question initially of new states, yes, we'll be looking at new states,
Yeah.
but they need to make sense for us from an overall ecosystem, if you want, of the brand. We don't plan to be everywhere, and we don't need to be everywhere, but we need to make sure that where we are, we have a significant market share, and where we are is, to your point, where people travel that know us
Yeah.
already.
Well, where you are definitely in some of the most lucrative markets in the US. The debt restructuring, it was something that had to be happened. But what we try to educate people on in this community is let's not look at a 30-day investment plan. Let's think 3, 4 years down the road. And it's very difficult at times in this day and age. But the most important thing is bright future for the industry heading into 2024, don't you think?
Totally agree. And I think that it's true for 2024. And when I look at those tailwinds, whether we're talking about federal tailwinds,
Yeah.
state tailwinds, I think 24 will be a year of transition with a lot of good news and good stuff happening. But the way they're going to play out from I'd say a revenue and bottom line will actually show up a lot in 25 and
Yeah.
obviously in 26. So back to your point, getting that maturity of the debt pushed to the end of 26 is super important because
Yeah.
that gives us a chance actually to have that time
Yeah.
to ripe the benefits of the work that's being done.
And it was nice to see those shoulders get crushed this fall too.
Well,
Yeah.
yes.
I know you don't look at your share price, but man, what a performance it's been over the last 90 days. You must be pretty happy.
Yeah, no, very happy. So hey, I'm not going to comment on the stock or say anything about that. But the only thing,
We
is
will.
yeah, no, please do. But yeah, when you look at what's happening from an industry plus what's happening to us, I mean, the fact that we have the debt above our head and maybe not as efficient and as others, when you put all that together and we can say, hey, we are in a different place today. I'm sure that plays into what you're seeing today. Yeah.
Yeah,
Very much, very much so. It shifted the sentiment of a lot of people that understood what was going on, not
Yeah.
people that were just looking at it at face value and being like, oh, they're giving up 30% of the company. I'm like, yeah, but it's at a $1.2 billion valuation down in 2026. Just let it be. The debt's not there. Let them build. Let the markets flip to adult use. And let's see what the story is come 2025,
Yeah.
2026.
Well, hey, we
And
should
it's,
take Rendezvous to 26 together and celebrate
yeah,
that. Yeah.
yeah,
Well said.
absolutely.
David, listen, I appreciate the time. Thanks for checking in. Let's keep in touch, okay?
All right. Appreciate it. Thanks a lot, guys.
Thank you.
Thank you.
Thank you for your
Thank
time.
you. Bye.
Hey everyone, so what'd you think of the video? Leave your comments below and let us know your feedback. We'd love to hear from you. As usual, subscribe to our channel by clicking on the link here. If you want to see more videos like this, then click on the link here and click on that bell for all notifications. Because most importantly, we want to know your feedback because we wouldn't be here without you. Thanks for watching, everyone.